Welcome back to the deep dive. For what feels like ages, really, we've been watching this dominant story, right? The AI rally.
Totally unstoppable. Or, well, that's what it seems like for a long time.
Exactly. Just powering everything higher, regardless of, inflation rates, whatever.
But last week, that engine kind of sputtered, didn't it?
Right.
We saw the first real significant pushback.
Yeah, that momentum just hit a wall. And volatility, it came roaring back.
Definitely. The kind we'd sort of gotten used to ignoring.
Right. So, okay, let's dig into this for you, because this wasn't just, a mild case of profit taking.
Yeah, it felt like more a genuine shift.
Yeah, a real change in sentiment. You had serious questions about tech valuations popping up.
Mm-hmm. And that was mixed with, well, huge uncertainty on the political and monetary fronts.
So our mission today, basically, is to help you navigate this complexity. It's like three storms converging.
Exactly. You've got the AI valuation doubts, a Fed that's kind of lost in a data fog because of politics.
And that ongoing gridlock in Washington that's squeezing the consumer. Three big things.
And the numbers, they really tell the story of the shift, don't they?
Oh, yeah. The S&P 500, okay, it held up a bit better, but still down 1.6%.
The Dow Jones down 1.2%. But the NASDAQ
took the real hit, down 3.0%. That tells you exactly where the pain was focused.
Right on those high-flying tech and growth names.
Let's start with that AI resistance then, because honestly, that felt like the biggest shocker.
It really was. For months, it was just spend, spend, spend on AI infrastructure. That was the only story.
So what changed? Did the market suddenly lose faith in AI itself?
I don't think it was about losing faith in the tech long term. It felt more like a collective reality check on profitability.
Okay, so less cheering the spending, more asking.
What's the payback? What is the actual return on investment, the ROI, going to be on these, truly staggering capital spends?
Right, and the symbol of this whole thing was Palantir, PLTR.
Absolutely perfect example. Palantir, PLTR. They delivered, a stellar Q3 report. Yeah. Beat expectations. Issued bullish guidance.
Everything you'd want to see on paper.
Literally the definition of good news.
Right.
And yet, the stock.
It just plunged nearly 20% off its recent high. That's huge.
Yeah. It really suggests that even amazing performance isn't enough anymore if the market thinks the underlying risks or the valuation are too much.
Okay, so that's the paradox we need to unpack. What were those specific investor concerns? It sounds like it went beyond just standard, it ran up too fast, profit-taking.
Well, I think it boils down to a few things, mostly around systemic risk and the cost of that capital.
Yep.
First, you actually saw a rise in credit default swap prices linked to the major hyperscalers.
CDS prices, so like the cost of insurance against those big cloud providers defaulting. Amazon AWS, Microsoft Azure.
Exactly. When that insurance cost goes up, it means the market's getting more worried about their financial stability, especially with all the debt they're taking on for this AI build-out.
Right. So the market's starting to price in the risk that maybe, just maybe, all this spending could become a problem in a higher rate world. That's a big shift from the euphoria.
Precisely. And you layer that onto the problems we already knew were there.
Yeah.
Valuations stretched super thin, more leverage being used across the sector.
And the concentration risk, too, right? Where just a few names like NVIDIA carry so much weight.
Exactly. All those things together created this environment where a sharp correction could happen, and did.
And meanwhile, the actual spending, the scaling race, it isn't slowing down at all, which just adds to the risk.
No, it's still full steam ahead. You pointed to that Amazon AWS deal with OpenAI.
Yeah, $38 billion over 7 years. The scale is just mind-boggling.
It shows the demand for capacity is just, insatiable. But the cost structure, that's starting to look unsustainable.
Okay. How so?
Well, we got a perfect example on the supply side.
Yeah.
SanDisk, which is Western Digital WDC.
Right, memory and storage.
They reported a 50% price increase in NAND flash memory. 50%.
Wow. And NAND flash is critical for the data centers, right, for storage.
Absolutely essential. So a 50% price jump in a key component like that, it translates directly, immediately into margin pressure for the hyperscalers.
So Amazon, Microsoft, Google, their costs just shot up.
Right. They're locked in this huge, expensive arms race to build AI infrastructure, and the price tag just went way up.
And then, okay, broadening out from just economics, we had some geopolitical stuff thrown in, too.
NVIDIA CEO Jensen Huang made that comment.
That China will win the AI race comment. Yeah, that made waves.
Big waves. He also criticized Western cynicism towards innovation.
Yeah.
Coming from the CEO of maybe the most important AI company right now, that unsettles people.
Because it brings in worries about, Further tech splits, losing access to markets.
Exactly. Geopolitical uncertainty, escalating regulations.
Yeah.
When a leader like Huang sounds that kind of note, the market listens and gets nervous.
And one more thing on the AI front, the OpenAI CFO mentioning maybe needing government loan guarantees.
Yeah, that really raised the too big to fail flag, didn't it?
It implies the scale of investment needed is just so massive.
The private capital alone might not cut it, that maybe government backing, taxpayer backing, ultimately, might be needed.
Which suggests the whole sector is reaching a kind of systemic risk level.
And that level of anxiety at the idea that AI boom might need a government safety net that definitely fueled some of the selling pressure we saw.
Okay, so that's a pretty stressed picture for AI. Let's pivot now to the second storm. The macro headwinds, particularly from the Federal Reserve.
Right. While AI was having its reality check, the Fed was dealing with its own paralysis.
That fog metaphor Chair Powell used before really seemed to fit last week.
It absolutely defined it. You had several key Fed officials coming out and publicly pushing back hard against market hopes for a December rate cut.
And their argument was basically, we can't trust the data because of the government shutdown?
Pretty much. They need reliable, timely government reports on jobs, inflation, manufacturing, consumer activity, all the core stuff.
And if those reports are delayed or the quality is suspect?
They're flying blind. So their logic was, look, if we're blindfolded, the prudent thing is to stand pat, do nothing. Which means no easing for now.
And that uncertainty, that Fed pause, it immediately spilled over. Right?
Yeah. Volatility popped. The VIX, the market's fear gauge,
jumped back above 20. That's a key level.
Yep. And Treasury yields also spiked midweek, hit their highest in about a month. Risk aversion showing up in bonds, too. Oil just kind of stayed pinned near $60.
But what makes the Fed's job just incredibly difficult right now is the data they're getting seems to be pulling in opposite directions.
Totally. It's a real tug of war, not a clear signal at all.
Okay, so where did we see the weakness?
Well, clear signs the consumer and the labor market might be cooling off. Challenger layoffs spiked up.
Highest since early 2023, right?
Yeah, suggesting companies are really starting to cut back. And maybe more importantly, University of Michigan consumer sentiment fell back to levels we haven't seen since 2022.
Okay, so consumers are definitely getting worried about the future. Those are pretty clear warning signs.
Flashing red, yeah. But then, on the other side of the coin.
You get signs of strength, suggesting inflation might stay sticky.
Exactly. The ADP employment report and the ISM services report both came in hotter than expected.
Ah, the services sector. That's the big engine of the economy.
Huge engine. Most jobs, most transactions. If that part is still running strong, it suggests demand is still robust, which keeps upward pressure on inflation.
So how does the Fed even begin to balance that? Cooling here, heat over there?
It's the ultimate balancing act. How do you justify easing policy when large parts of the economy still seem pretty hot? That's their nightmare.
Which flows right into the third converging force we talked about, the political noise, Washington gridlock, and how that hits consumers on the ground.
Yeah, the instability from D.C. was definitely a factor, adding friction.
That government shutdown just keeps dragging on.
Total impasse. Seems like the political class just isn't governing effectively right now. And President Trump voices frustration.
But his calls for Senate Republicans to ditch the filibuster were just ignored.
Pointedly ignored. Yeah, just reinforcing that feeling of paralysis, of gridlock.
And we saw that instability actually lead to policy decisions that affect the economy, like that transportation secretary order.
Oh yeah, cutting U.S. air traffic by 10% right before the holidays.
That drew a lot of criticism. Seems like adding friction for no good reason.
Exactly. It means delays, higher costs for businesses, frustration for travelers, just adds unnecessary logistical headaches to an already stressed system.
And if we link this political friction and the sticky inflation back to the average person, we saw some really telling signs in corporate earnings, McDonald's.
Yeah, ticker MCD. Their overall results look pretty solid, actually, but they specifically highlighted a sharp decline in traffic from lower-income consumers.
That feels like the canary in the coal mine.
It really does. It signals that those consumers, who often rely on fast food, are feeling intense budget pressure. They're being forced to cut back even on relatively affordable things.
Deep squeeze on household budgets.
But interestingly, compare that to Wendy's, W-E-N.
They said their value menu items were doing well.
Continued strength there, yeah. Which suggests people aren't stopping spending completely, but they are absolutely trading down, looking for the cheapest option.
Makes perfect sense. It's not just belt tightening. It's a real income squeeze forcing different choices.
Right. And you see it hitting bigger discretionary spending, too. Norwegian Cruise Line, NCLH.
They missed revenue, trimmed guidance.
Yep. Cited higher costs, but also weaker bookings when people start pulling back on big, expensive vacations.
It confirms that household budgets are seriously tight and people are rethinking future plans.
Definitely curtailing that forward planning.
So all these things, the AI reset, the Fed fog, the consumer squeeze it, just crushed market sentiment, didn't it?
Oh, absolutely. The fear and greed index is the perfect gauge for that emotion. It dropped like a rock from 35, which is already in fear territory,
All the way down to 21. That's extreme fear.
deep into extreme fear. That's a huge psychological shift in just 1 week. Market momentum, market breadth, how many stocks are actually going up, all hit those extreme fear levels.
And the put-call ratio, still showing nervousness.
It eased back just a tiny bit, but yeah, still very elevated, still signaling a lot of underlying unease, a lot of defensive positioning. Fear definitely tightened its grip.
Took over from that kind of carefree AI enthusiasm we saw for so long.
And this risk-off mood hit basically all asset classes. Crypto sold off right alongside tech. Bitcoin actually dipped below 100K for a bit.
Wow, below that big psychological number. Bounced, though.
It did bounce, yeah. Support seems to be around 108K for now, with lower levels like 103K and 99K if needed. It just confirms how tied it is to that broader tech risk sentiment.
And the dollar, the DXY.
The expectation is it might stabilize a bit, especially if or when the government shutdown finally ends.
A stable dollar could provide a bit of an anchor, but that's totally dependent on the politics getting sorted out.
Entirely.
Yeah.
So if we just zoom back out for a second, what we've really described is this collision, right?
Yeah. 3 powerful, distinct storms hitting at the same time.
You've got the market suddenly challenging the whole AI trade's viability, or at least its near-term profitability.
Then the central bank kind of forced onto the sidelines because they don't have the data they need.
Right, that necessary hesitation. And layered over all of it is this paralyzing political uncertainty that's feeding directly into real financial stress for consumers.
So looking ahead, what are the key things for you, for the listener, to watch next week?
Well, the immediate focus has to be back on the Fed. Next week is packed with Fed speakers. You've got Barr, Williams, Waller, Bostic, a whole bunch of them.
Everyone will be parsing their words, trying to see how they're navigating this fog while the data is still messy.
Exactly. And of course, the background factors remain. The shutdown impasse, any ongoing election fallout. Those will continue to cast a shadow over confidence.
It feels like we've definitely shifted from a market where you could just passively ride momentum.
Oh yeah, we're firmly in a market that demands active risk assessment now. The ground is really shifted under our feet.
Okay, so we'll leave you with this central question really drawn from all the sources we looked at this week. Given that sentiment, measured by the fear and greed index, has plunged deep into extreme fear, and the AI sector, which looked invincible, has suddenly shown real vulnerability.
Yeah, the big question is how you interpret this moment.
Exactly. Do you see this as a healthy correction, something needed to wash out some of the speculation and froth from the summer rally?
Or is this maybe the definitive start of something bigger? A longer, more painful unwind for those super high-value tech names.
Something for you to definitely chew on. Think about how those 3 forces, AI risk, Fed uncertainty, and political pressure, might dictate the answer in the coming weeks and months.